The market has been very volatile, and I actually haven't been a huge fan of the market, believe it or not, the entire year. I've thought it's been very choppy and whippy, and we've just been sort of consolidating in a range. And I think a lot of that, believe it or not, is still some overhang from 2013. The market had been up 30%, and I think that the last year and a half or so has been the consolidation, so to speak. Now, the economic data since then has been rather crappy, to say the least. We've been having egregious durable goods orders. The GDP forecasts, which started out in the Atlanta Fed, have now been basically brought to zero. And the unemployment rate, while as cosmetically is looking like it's lower, is really not that good. The labor participation rate is roughly about 62.7%, which means about 40% of the country is not working. And the jobs that they have are lower paying and of a lower quality than would be typical of a recovery. Now, the Fed is aware of this. I believe that we happen to be living, despite what people might say, in a golden age of Federal Reserve policy. As opposed to what's happened in the past in other eras with policy mistakes that have led to some pretty disastrous financial results. But the Bernanke-Yellen Fed has proved itself, in my opinion, quite competent, at least so far. So what was Janet Yellen saying yesterday? She was saying she thought that equity prices were quite expensive, but not as much as bonds. And I believe that this was a professional attempt by Chair Yellen to do what Alan Greenspan did in 1996 with his irrational exuberance speech to try and quell the market from sort of really blowing off and boiling over, because they know what kind of crisis that leads to. Now, this was also known in the 1920s as moral suasion, and it didn't work then, and it will not work now. So my opinion is that this unemployment number tomorrow, whether it's good or not, I don't think is going to be enough into itself to really change the Fed, at least as far as I'm concerned. If they are true to their word, and the Fed is saying that they believe that interest rates, that they're going to handle interest rates based on data dependency, based on the data that I just described to you, they should be easing and doing more QE, not raising rates. So with that backdrop, there are plenty of things the Fed can do to tinker with the markets. They could, if they want, raise interest rates or at least scare people into believing they will. They could also raise margin requirements, which probably would cause a pretty nasty little correction if it happens, at least a few-day pullback. But I don't really think that the issue is the public being in a wild speculative orgy like they were in 1929 or in 1999. It seems to me, and I recently wrote an article that was featured on Jim Cramer's websites, actually, called realmoneyandthestreet.com, and I talk about how there's a bubble in bubble watchers. And basically, everyone is sort of looking for the top, and that the market in and to itself is trading not in a euphoric state, which is what you really need for an era before a crash, but in a very tentative and scared way, albeit at all-time highs. So I think the fear here is people not wanting to be the bag holders, sort of like the last person standing who buys the market, and then they get caught in the top. And yes, it is very possible we have a pretty, it is always possible to have a fairly sizable correction. A 10% correction can pretty much come at any time. So keep that in mind. So my thinking, I just see someone mentioning, you mean a slow crash. There's no such thing as a slow crash. A crash in and to itself is loud and noisy in and to itself. But I will say there have been some cautionary signs that I've been seeing lately. And some of those you probably have realized, and if you haven't, you may just be ignoring them. One of the things that has had me very cautious is the fact that companies that report earnings, and they have great earnings, like Apple or Gilead, have these run-ups, and then they don't hold, but they fail and sell off. And in instances, they're not holding their gains. The opposite, though, is so for companies that miss earnings, as you saw what happened with Yelp and Twitter, although Yelp is a bit of a different story because they have some takeover potential, and I'll discuss that in a minute. But I think that the issue is that people are just maybe a little tired. These names have been chased, and when they miss, they come down, and they come down huge. And if they beat earnings, they go up a little bit, or they don't really hold, or they're up for a day or two and then come back. And I think it's just that the market is, I wouldn't say toppy, it's just a little tired, and it needs to either correct a bit or it needs to have some sideways action, and we have been having that sideways action. So the question now is, are we going to go higher or lower? And the answer is that I'm really not that sure in terms of how we're going to react, let's say, tomorrow. Although I will say that I would have liked the market to have come in weaker. Like if we were down today and early tomorrow, I would have said that the market probably set up as long. But we did, and we have done everything so far technically correctly. We held the 100 MA very well. The market, the S&P hasn't really fallen off a cliff. It's held reference support, and it is still sort of, I've been talking about the upper distribution. It's sort of in the cautionary zone of the upper distribution, although I will say today I didn't like that it couldn't close over that 208.97, which is sort of the upper really for still higher prices. We closed just below there. Now, what I'm going to fall back on, and I tweeted this out today, and I've been saying this the last few days, is that people keep chasing the market up, they don't get rewarded with higher prices, and then the market comes down and there's this fear, and then you have people who pile on and short, and they think that they do it sort of after a larger move intraday has happened, and they do it sort of away from value, and then they get it ripped back in their face up higher, and it's just this choppy push me, pull you type of a market, which is, I guess conducive for traders, but for the most people, like the public, for example, they like trending markets, like up every day, for example. So what I'm looking for here, and this would give me a little bit more clarity, and I've discussed this in some videos, is I really want to see the S&P at least SPY over 208.97 to 209.33. And where do I get that number from? There had been a reversal day, and the next day was sort of this inverted hammer. I'm sorry, not an inverted hammer. It was an actual bottoming tail hammer, very large. And the next day was a Fed day, which was an inside day. So usually what I'll do is I'll go by the Fed day range, but since the Fed day wasn't really the defining day that it should have been in terms of their range, it was just an inside day. By the way, I had mentioned I was a little cautious with that because the body of that day closed below the hammer's body. I don't want to get too technical or wonky here because I can't really show this to you on the charts on Periscope, but if we're below that range, the market, in my opinion, is still vulnerable. If it's inside that range, it's sort of going to be just choppy, and if we can take out that range, I think we're going to go still higher. All right, so I'm just reading some of the comments that are coming across. So with that said, like I said, I'm very cautious. When the market, when I'm sort of not sure of the direction that we're going to go in, I tend to do a few things. One, I trade in smaller size. I trade in shorter time frames, meaning that I might go for a swing intraday or for the next day or two rather than for weeks. I look for smaller price moves in terms of my goals. Like if I'm normally looking for like a $10 swing, maybe I'm going to only look for a $5 swing, or at least trim and trail a little bit more quickly because I realize the market environment that I'm in. And it's sort of that philosophy, the aim small, miss small. So if you don't take too big of a swing, you're not going to come out of your shoes, so to speak. That is one thing that I think will keep people sort of safer in this environment, at least protecting profits. One thing I've been discussing on the stream, and it really is bothering me, is that a lot of people, particularly some followers, I don't want to call anyone out, of course, but have been not exercising the proper risk management discipline. And I have a video on that. And if you could really master those, I guess, principles, I think you'll improve your trading returns tremendously. Really, the trick for professionals is not to incur these huge drawdowns, because then you spend, the better part of a year or more trying to make back the money you lost. I know that, the media likes to talk about, alpha, generating alpha. They do endless discussions about this. Excuse me. But the truth is you should be okay with missing a few percent in terms of the upside return if the risk for the downside is super duper asymmetric. The same with the alternative. If you're playing short, if the risk starts becoming asymmetric, price really matters. You might want to trim that short, and you might want to be playing for a long move. So we are still in a responsive, low confidence market that has been respecting technicals. So as long as that happens, I think that the market is still quote unquote okay. Although one of the things that was a little bit troubling to me was the last couple of days we had trend days, and they were downtrend days, coming off of weeks and weeks of MOC, which is just the buy imbalance, which has been majorly to the sell side for the last month. And when the larger institutions are in the market, they tend to have the trend days because they're not looking at like Fibonacci, levels. They're not looking at opening balances. They're not looking at overnight high and low reference points. They're just selling or buying, and they just buy a little here, they buy a little here, they buy a little here, or in this instance, they sell a little here, they sell a little here, and they sell a little here. They don't wait all day until the end of the day to be flat. They're just constantly selling because they're trading in a different type of volume. Like to sell 1 million shares of Apple is very different than to sell 1,000 that you and I might be trading in. So, or 100 or 50 or whatever, whatever size that you're in. So, speaking of Apple, why don't we discuss Apple? So, I'm seeing Apple, I'm looking at the chart, they had a really good earnings number, and this is one of the things that has gotten me really cautious on the market, is that Apple wasn't able to, it sort of broke the pattern that it had been in. If you look at a chart of Apple before earnings, it sort of ran up, chopped for a while in a range, and then it was able to break out and do the same thing again, and then this time it was able to go higher in the after hours, but it wasn't able to hold those gains, and it wasn't able to hold over the high of day. Now, Apple now currently is sort of at the lower part of its range. It's like 122, 121, 122 to 125, and I'm not necessarily sure that it breaks down per se, but I would say that the risk for me with Apple is to the downside as long as it's making lower highs and lower lows. If you look at this rally it had a few days ago, it topped out at it did actually get up to 130, but it promptly sold off, and it actually took out the low of the prior swing. So you now are in a bit of a pattern on this leg of Apple making lower highs and lower lows. And the key to me really for Apple is to hold over the Dow Jones Industrial Edition pre-market spike high, which was 129.85. Just keep that number in your mind. If you're below the 20 and 50-day moving averages, that's kind of your first line in the sand of weakness. And if you're still below the 129.85, and then even the other reference high, which was 133.60, the path of least resistance for Apple is sideways to lower. Sorry, guys, I know my voice and such. Anyway, so that's my opinion on Apple. I've been playing this endlessly for the last few weeks. Unfortunately, it hasn't paid off yet with put ratios, and I've been playing around with like the 123 to 119 strikes, meaning buying like 122s or 123s and selling 120s or 119s. Is the 100-day moving average in play? Yeah, I mean, as long as you're below the 50, sure, why not? That's actually the 121 area. That's actually the low of the range. So I would think that would set up as a nice row buy. So what's the better way to play Apple now that we know we're in this chop zone? Well, we know we have a channel low in Apple currently, somewhere between 117 and 119.75. And we know we have a reference low of Apple around 121.63. So what I think the best way to do with Apple is to wait for those reference lows and to either buy them for right or right out trades, or to wait until you have sharp moves down in Apple that get the implied volatility high. Currently, the real normal implied volatility for Apple is 25 to 26. And actually, I think we got a little low today. I think we were actually trading like 23. Excuse me. Yeah, but next week is 27, so it's still within range. If you can get that elevated into the mid-30s, it's a good idea to use that to sell out of the money premium. And I honestly think you can sell both calls and puts, because if Apple winds up rallying, that premium will get crushed, and you'll wind up having a contraction in the price of in terms of the calls and the puts. So that's sort of how I think the best way to play Apple is to wait for some type of reference levels, or to play it in terms of being short premium. That's actually how I'm going to be playing it going forward. So that's Apple. The other thing I just want to jump back into, in terms of the risk appetite, so to speak, is the small caps, which is the Russell 2000, and you could use this by use IWM. And I think the immediate term line in the sand here, and if we may get resolution on this tomorrow, it has sort of snapped its channel, but it still hasn't snapped trend. And the immediate term line in the sand for me with IWM is this 120.97, which was the old high. As long as we're above that, I think that you could kind of play BTD in the market. If you're below that, it might get a little bit iffy, and you could see the 119.39 and potentially even down to 117.37. Anyone who's been following me for a while knows the significance of those numbers, particularly the 117.37. If that were to snap, currently the channel low is around 111. I think that will move up, though, because I don't think it'll be a straight shot. So that's my thinking on IWM and the key levels. What you'd really want to see IWM now, particularly if the Fed is quote-unquote, or I wouldn't say the Fed, but I would say the unemployment number, quote-unquote, is good. You're going to want to see IWM take back that breakdown bar high, and that was 123.44. So anything below there, I think you could be a little bit, I would say, iffy and tentative as far as playing those types of trades. So there have been a lot of earnings this week, and again, I can't share the charts with you guys, but I want to discuss a few of them that I see as being, I guess, important. Hold on, I want to just read some questions. Do you look at smaller time frame, RSI, and show market? What I'll often do is I don't use the RSI per se, but I use stochastics, which are basically the same principle. So yes, I guess I do. Yes, I look at stochastics, and I look where something is in terms of in terms of if it's overbought or oversold, particularly on the intraday. I find it very useful. Or if I'm looking for a longer swing, I know where I'm getting good or bad trade location. But the way I use to buy the dips, so to speak, for me the key things are the horizontal supports, the levels, the trend line. Those two are the most important, and then I would say the Fibonacci retracements and the moving averages then become the next the next key levels to use. So are there any since this, I don't really want to lecture to you guys. I'd love to have some back and forth. Do you have any, I could see on the screen if you type in some stuff, if there's anything in particular you're curious about. It would be better if it wasn't like always stock specific and required a technical answer, because I can't show the charts, but if there's some, do you look at order flow? Sometimes I do. What I do use often is I look at, and particularly what I found important for Apple, is I look at the open interest in the options. Like I had discussed last week, the 125 being a put wall. And the put wall to me meant that the stock had a very low chance of being below 125 because there were like over 100-something thousand options in the puts there. And options tend to like to kind of fudge the most people, so to speak. And keeping the stock below there would not have accomplished that in terms of the puts. So I saw that being the sort of the floor. Should you be? That's a good question. The question was, should you be playing the indexes Yeah, we're going to discuss Bob in a second. Thank you. That's going to be in 1 second. I do believe that you can play individual stocks. You know, the indexes, there are some people who like to only play the indices, and you can do that via the futures or SPY or what have you. Either way is fine. It's just really a matter of your style. I tend to like to play both. I usually play, personally, excuse me. So I tend to play both. I tend to play in SPY, and then I tend to play in a narrow set of stocks that I know very well, like I know their behavior. Often one of the mistakes I see is that, and I discussed this in my risk management video, is that people tend to try to play every move in every stock every day. And often there aren't moves to be played in certain stocks. Like, for example, today in BABA, I was getting a ton of questions from people about what to do with BABA. And I had said that it had opened up into some resistance and it was probably a good area to sell, but that if we got over the high of day, that there could be a run to 100. So in my opinion, and I'm looking at BABA right now, actually I'm not looking at BABA, I'm looking at some other stock, but now I'm looking at BABA. So BABA today gapped up and it got right to the channel high and it got right into some reference highs and some supply. So if you were long BABA and you were wrong, today some of you got your money back. Like if you bought the gap down, playing for a move back up to play to fill the gap, the stock continued down and it's been, trading terribly for the last few weeks. And I think today was just a bit of a relief rally. I had discussed this play actually, that I thought that it would be a shake and bake where the stock would break the 80, take out the stops. We never really got a lot of volume there though, and then would rally back up for earnings, and that's exactly what had happened. But for me, I haven't really been playing a lot of these earnings because of the simple fact that the risk is so asymmetric that if you get it right, you're sort of rewarded temporarily with higher prices, but if you get it wrong, you're absolutely obliterated. So I think the better play with these stocks is to wait until post-earnings and give them maybe a day or two to shake out to kind of really show their true hand. If they are strong, like if you take a look, it's not a stock I talk about very often, but it's actually, believe it or not, one of my favorite stocks. This will be the first time any of you get to hear this name, and it's Estee Lauder, EL. I think that this stock is a monster, and it's probably going to go considerably higher. Does that mean I would run in if I didn't have a position in it right now? Maybe not. The stock has been up a lot. It's a slippery tape. What you need to see, though, for this, for example, like if you look at what it did 3 days ago, it gapped up, and it has it looked a little bit into the gap the next day, and then the next day, today, it was higher. So you still haven't taken out that earnings gap high of day, which is that 89.84. So I think if you can get above there, you probably can see the channel high, which comes in roughly around 91 bucks. I'm thinking that this stock will eventually make it to 100. That's my thinking. And this is a buy the dip stock for sure. I would be looking to buy this on a pullback if you're not involved in the stock. So we have now officially discussed a name that I have never mentioned, but is one that I do like and have been watching for quite some time. So that's an example. You want to give it a few days. Now, with regard to BABA, which is one I do discuss quite often, what you really want to see with BABA, and I think that this could happen, is that they have a lockup coming up in September. And their lockup is really big. I mean, it's like a lot of shares, and it's going to be happening in September. So I believe that they need to somehow manipulate the stock higher in order to unlock those shares. They can't do it with the stock plummeting. So I think that there's going to be kind of a concerted effort, and this is just my thesis, to get BABA higher. Now, I think that the risk in the medium time here is not decided yet. Anything below today's high of day, I believe the risk is lower for a gap fill. If you can clear the high of day, which is 89.29, I think that it's going to make some attempts into the gap. I don't know how fast it's going to be. There may be some resistance, but I think that if you can clear that 89.29, and then after that clear 92, will be some resistance. There'll probably be some sellers up there, but once you can clear into there, I think the stock can get back to 100 and fill the gap from the last debacle of the earnings. And that wouldn't surprise me to see that, but you really need to see it clear that 89.29 first, because I don't know that it's going to go higher per se. It may want to come back down and, like, for example, retest the 50-day moving average or something like that, or even come back and maybe test 82s or 84s, which were past, important levels. So you really need to see the down channel snap, and I often talk about that. Someone had just mentioned that in regard to Tesla. And let's talk about Tesla now. So Tesla, a couple of weeks ago, I had discussed was going to be a long, that I liked how it sort of had a look below range, very similar to BABA, and fail and went back up. And then once it broke the channel, I had discussed that it was a long again. And it took its time. It was sort of meandering sideways, and I had said that I thought that the quarter was going to be good because it was pre-announced, basically. And the stock proceeded to rally, and it got up to the 238 level. Now today it was oddly a very, very strange behavior in Tesla. It was up in after hours, and I had discussed yesterday on the stream that I thought it was a little bit weak in terms of the response that it was having after hours, in terms of earnings, in terms of the size of the move. Now Tesla's a momentum name, and within every momentum stock, they need to continue higher. The minute they don't continue higher, like the minute there's any doubt in it, that's when they go back down. So you need the momentum to stay higher. Now today, it sort of went down. It wound up being weak, like I had said it was, but it found some strength, and it found it off the channel low. So what I think is going to happen now with Tesla is one of two things. One, it's either going to, today was sort of a one-day wonder, and it's going to pull back and just be really choppy in range. And I think it really needs to hold that 225 to 226 level. The risk below there, and the 200-day moving average is 227.28, so roughly around that area. So if you lose that, the low of day will be in play again, which is 220. And then if that's lost, you're looking at like 203 to 206, which is the real true support. And if it gets back down there so quickly, I think it's going to be really choppy because it couldn't, quote unquote, go higher on earnings. Now, the other scenario, and it would be really advantageous for the stock to do this in a gap because it would really, really trap the shorts. And this is a story that is a game with the shorts. Yeah, I'm going to talk Gilead in a minute. The story with Tesla is it's a poorly distributed stock with high consolidated insider ownership with a high short interest. And that short interest is what's really fueled the move higher. So if you can get Tesla above 238.75, which was sort of the range spike high, then you really need to clear there between 238.75 and 239.50. So anything above there, I think you can see the 42s again, 45s to 46s, and maybe fill up the gap to 257.70. So that's what I'm thinking. If you can take out the that sort of 238 to 239 range, then you can see higher. And if it does it in a gap and it holds, then you can play over the first 15-minute high. If it does it RTH, same kind of way. The power of the gap, though, is sort of what freaks people out, because if you're short, you're trapped. Gilead, that was an example of a stock that did exactly what I was talking about, like the Apple, where it was looking strong and it wound up being kind of okay for a day trade, and then like the rest of it sort of wasn't so great. But it got up close to the 108.45 gap fill. It actually got up to some reference highs, and then it just completely sort of fell apart back down. And I had talked about that this was still a buy the dips name for me as long as it held the 105 to 103 range, and that failed, and the stock came back down, and 100 was, I had been talking about, as the key level, and it sort of looked below and then held, and then today closed in a very violent hammer higher, and the hammer closed above the 50-day moving average and into the prior day's range, which I thought was sort of encouraging. But the stock to me is really not acting great. The body of today was still below the body of yesterday, which is a little bit iffy to me. So I would say that if it loses the 50-day again, you sort of, I mean, we just closed just right over it. You probably want to be a little cautious. And I would say that it could probably be a good day trade, though, if it goes over today's high of day tomorrow for some type of a right or right out situation, move over that hot hammer, I think you could easily get back up to the somewhere between the 103s to 105s area, maybe even higher if it's a strong hold. The danger you run is that it forms some type of a head and shoulders here within the pattern, but that wouldn't really happen until 105 anyway, so the day trade would still work. That's my thinking with Gilead. Are there any other questions that you guys have? I'd love to get some more less chart and technical ones and a little bit more qualitative ones as opposed to like ones that you sort of need to look at a chart for. Oil. That's a good question. That was actually one I nailed the bottom in. I also nailed the bottom in the euro. If you take a look back at some of my my tweets and on the stream, oil today ran into some resistance of where the breakdown was. It's still kind of holding in a I would say in a rising pattern. So it's still too early, I would say, to call the top in the move of oil. But it definitely has had some response. It closed right on trend, basically. So we should get an answer tomorrow. I would say if oil can break above 62.58, it's probably going to go a lot higher. It could even, believe it or not, it could even get to the breakdown of of like 72s to 75s. I think that area will be really, really hard for it to get back up over. It'll be interesting to see, though. I need to do a little bit more work on oil as far as like Fibonacci retracements and such, but for the interim time being, that swing high here is really the key. As long as it's below 62.58, the path of least resistance is quote-unquote lower. If it gets above there, it's probably going to go at least to the 200-day moving average, which is 68.82 right now. So that's my feeling on oil. Anyhow, I think we covered a lot of good stuff here. I'm thinking about calling it a day. Let's just talk about the euro quickly, because that is one that I had kind of called the bottom in. So I've been looking for the euro to make some type of a check back to like the 120 area. I don't know if we're going to get there, but we are definitely starting to make higher highs and higher lows inside of this leg and this pattern. We've come back into some, I guess, reference resistance here, and excuse me, I'm sorry. I would say that if you look at the Fibonacci retracements, the 38.2 is 117.22, and the 50% is 121.59. So that's sort of where I'm sort of bowling for, where I think that there could be a run too. I don't know how much higher we would get above there. Really, the breakdown occurred below 122. So we'll see what happens. The Europeans are trying to deflate their currency. We'll see how successful they are. We'll see. I think a lot is going to depend on the Fed and some of the talk that comes out of there. If the Fed keeps talking tough, the dollar will rise again. But the dollar had sort of overshot, in my opinion. It was getting a little bit sporty. Excuse me. I had talked about that. It is now making lower highs and lower lows. So I would think that there might be a little bit more giddy up in terms of the euro, although you've broken trend in the dollar, although there might be some type of a throwback. It's been a lot really fast. Maybe if the Fed is a little bit more hawkish in their talk, or maybe if the unemployment number is a little bit hot, you might see a bit of a rally in the dollar. Anyhow, that's I think that covered a good amount for now. I'll be talking about some more stuff on the stream. If you haven't had a chance, check out my article on thestreet.com. I'm going to post it. This video is going to be posted, if you didn't catch the whole thing, or if you know people who had missed it, it's going to be on my YouTube channel shortly. I'm going to try and upload it now, actually, so it'll be up pretty quickly. And there will be in the description a link to the article that I wrote. It was originally called Rise of the Investing Twitterati, but I think the free version, it's called like Twitter Trumps traditional media for investing or something like that. I'll post a link, and you could check it out. Anyhow, be sure to subscribe to my YouTube channel, which is Justin Pulitzer Trades, And if you're not following me on Twitter, be sure to follow me on Twitter. My handle is @JustinPulitzer. I talk about a ton of these trading ideas and setups. I answer questions. And I guess you'll get the notifications for Periscope type of events like this. I'm going to do something a little bit different in Periscope in the next week or two. I'm going to do I'm going to have somebody do a live interview with me and ask some questions. Hopefully some tough ones. I don't really want the easy ones. I like the tougher ones. So if anyone wants to submit some of those, like if you have any questions, you could send them to myname@gmail.com, and we'll use that for some of that event. That's going to probably either be next week or the week following, or maybe even a special one. Like I won't interrupt these types of sessions for that. Maybe it'll be like a special event, Periscope. Anyhow, thank you so much for tuning in, and I will see you later. Cheers.